Hey everyone, it's red2learn_diaries_books, and today we're diving deep into a topic that's close to my heart: real estate. Now, you've probably heard it a million times. Real estate is a safe investment. They're not making more land. But let me tell you, that's not the whole picture. In fact, there are some serious downsides to real estate that nobody really talks about. And today I'm going to break them down for you. We're going to expose the real estate trap that's caught so many unsuspecting investors off guard. Look, I'm not here to bash real estate entirely. It definitely has its place in a diversified portfolio. But before you go sinking your hard-earned money into that dream property, you need to be aware of the potential pitfalls. We're talking about things like massive upfront investment requirements, the illiquidity of real estate assets, hidden costs that can eat into your profits, and the often murky world of real estate transactions. So buckle up, because we're about to uncover the truth about real estate investing and why it might not be the golden ticket to wealth that everyone makes it out to be. By the end of this video, you'll have a clear understanding of the risks and challenges involved and be able to make a more informed decision about whether real estate is the right investment for you. Let's face it, getting started in real estate requires a serious chunk of change. We're not talking about a couple of $100 here. You're looking at down payments, closing costs, property taxes, potential renovations. It all adds up faster than you can say mortgage. And don't even get me started on the competition. In hot markets, you'll be up against seasoned investors and even cash buyers, making it even tougher to break in. This high barrier to entry is a major roadblock for many aspiring investors. It's not like buying a few shares of stock. You need substantial capital up front. This limits accessibility, often excluding those who could benefit most from wealth-building opportunities. So, before you jump into the real estate game, make sure you've got the financial firepower to back it up. Don't let the dream of owning property turn into a financial nightmare because you underestimated the initial investment required. Imagine this. You've poured your savings into your dream property, but then an unexpected expense pops up. You need cash, and fast. Problem is, real estate isn't exactly known for its liquidity. Unlike stocks, which you can sell with a few clicks, selling a property takes time, effort, and a whole lot of paperwork. You've got to find a buyer, negotiate a price, wait for inspections, appraisals, and hope the deal doesn't fall through at the last minute. This whole process can take months, even years to complete, leaving you high and dry when you need cash the most. This lack of liquidity can be a major drawback, especially compared to more agile investments. So, if you're someone who values flexibility and quick access to your money, real estate might not be the best fit. When it comes to real estate, it's not just the purchase price that'll hit your wallet. It's the hidden costs that can really sting. We're talking about closing costs, property taxes, agent fees, insurance, maintenance, and the list goes on. These expenses can easily add up to 10% or more of the property's value, eating into your potential profits. And don't forget about ongoing expenses like property taxes, which can fluctuate over time. These recurring costs can put a serious dent in your cash flow, especially if you're not prepared. Before you make an offer, factor in all these expenses to get a realistic picture of your potential return on investment. Remember, it's not just about the purchase price. It's about the long-term costs that can make or break your investment. Chapter 4: Murky Waters: Navigating the Real Estate Maze. The real estate world can feel like a jungle sometimes, filled with complex regulations, legal loopholes, and shady deals. One wrong move, and you could find yourself tangled in a legal battle that drains your time, energy, and finances. From zoning laws and building codes to property disputes and title issues, there's a lot that can go wrong. And let's not forget about the endless paperwork, bureaucratic hurdles, and slow approval processes that can make even the simplest transaction feel like an uphill battle. This lack of transparency and potential for legal headaches can be a major deterrent for many investors, especially those who prefer a more straightforward and regulated market. So, before you dive headfirst into a real estate deal, make sure you've got a good lawyer on your side and do your due diligence to avoid any nasty surprises. Chapter 5: The Harsh Truth: Real Estate versus Stocks. Let's talk about the elephant in the room, the actual performance of real estate compared to other investments. While it's true that property prices can appreciate over time, they don't always outperform the stock market in the long run. In fact, if we look at historical data, stocks have consistently delivered higher returns than real estate over the past few decades. For example, in India, between 2003 and 2013, property prices skyrocketed by a whopping 8 to 10 times in some areas. But today, that growth has stagnated. Meanwhile, the stock market, despite its volatility, has continued to climb, leaving real estate in the dust. Don't get caught up in the hype. Understand the historical context and long-term trends before making any investment decisions. So, if real estate isn't always the best performing asset, why do people still flock to it? Well, it often boils down to one word: safety. Many people, especially those who've been burned by stock market volatility, view real estate as a tangible, secure investment. They like the idea of owning a physical asset they can see and touch. However, this perception of safety can be misleading. Remember, real estate is subject to market fluctuations just like any other investment. And here's the kicker. While people are comfortable holding on to real estate for 15 to 20 years, they often panic sell stocks at the first sign of a downturn, missing out on potential long-term gains. Don't let fear and emotion dictate your investment decisions. Think long-term and diversify your portfolio to mitigate risk. Now, within the realm of real estate, you've got different options, each with its own set of risks and rewards. Commercial real estate, like office buildings or shopping malls, can offer higher potential returns, but often requires significant capital and comes with its own set of challenges, like finding and retaining tenants. This segment is typically dominated by big players like multinational corporations and high-net-worth individuals. Residential real estate, on the other hand, while seemingly more accessible, is facing its own set of problems, particularly in oversupplied markets. Slowing appreciation rates coupled with rising interest rates make it increasingly challenging to generate attractive returns. So before you dive into either commercial or residential real estate, carefully consider your financial situation, risk tolerance, and investment goals. There's no one-size-fits-all approach. So, if you're looking for ways to participate in the real estate market without the headaches of direct ownership, there are alternatives. Real estate private equity funds pool money from multiple investors to invest in large-scale projects, offering diversification and professional management. Rental yield funds focus on generating consistent income by investing in properties with strong rental potential. Another option is REITs, or real estate investment trusts, which allow you to invest in a portfolio of income-generating properties with high liquidity. And finally, there's real estate debt, where you essentially become a lender by investing in instruments like non-convertible debentures, earning fixed interest payments. These alternatives offer varying levels of risk and reward, providing more flexible and potentially lucrative ways to participate in the real estate market without the burdens of direct ownership. So, there you have it, the real estate trap laid bare. Look, I'm not saying real estate is inherently bad. It can be a valuable part of a diversified investment strategy. But it's crucial to approach it with a healthy dose of realism and a clear understanding of the risks involved. Don't fall for the get-rich-quick schemes or the allure of easy money. Before you jump into any real estate deal, do your homework, crunch the numbers, and consider your investment goals and risk tolerance. Remember, there are alternative ways to participate in the real estate market without taking on the burdens of direct ownership. The key is to be informed, strategic, and most importantly, realistic about your expectations. Would you still invest in real estate? Let's discuss in the comments.